What do you think about bonds?
We all know about bonds. You give them to your snot-nosed kid when he turns 15. Maybe when he's 30, he makes $100. Boring.
What? No, Ryan, come on, bonds are awesome. They're all the buzz because you can get more than 5% on bonds right now. And in the bear market we're currently in, those are starting to look a lot more attractive in the short term. You ever feel like too much of your money goes to paying taxes to the government and wish there was a way to get paid by the government? What in the heck is the government even using our taxes for? The roads are all messed up, you have to build up debt to go to college, medical expenses are through the roof, and the government is still racking up a crazy amount of debt. Where's our money going? Well, with the government being in that much debt, you better believe they'd be willing to pay you to loan them some. And that, folks, is what a bond is. I know, that still requires giving money to the government. But, and there's a big one, you get paid every 6 months, plus you get back what you gave them in the beginning if you hold the bond until its maturity date. Let's break it down. A bond is basically a loan agreement between you and the federal government, a government agency, a local government, or a business. And in turn, they pay you interest on what's called your principal, or the amount you start out investing with. If only we could charge the government the same interest rates credit card companies charge us. Wouldn't 23.5% interest rate be nice? Now, the government basically uses all of our money to pay for defense, social security, and healthcare programs. Those are by far the largest categories in terms of spending. Despite the fact that 1 in 4 Americans have no retirement savings, Social Security cash reserves are projected to be depleted by 2037, and about 30 million Americans are without health insurance. It makes you wonder. I'm on a rant here, let's get back on track. When you loan money to the federal government, those bonds are known as Treasuries. They're one of the most common fixed income investments. Fixed income, or debt securities, are just a fancy way of saying bonds. There are 2 main characteristics we're interested in: maturity date, or the time at which the principal must be repaid to the investor, which could be you, and the yield, or the defined rate of return you get on the bond. There are a couple of important things to know about these 2 characteristics. Let's start with maturity date. There are 3 basic types of treasury bonds that relate to maturity date. Treasury bills, which is a bond you hold for less than a year. Treasury notes, a bond you hold for 1 to 10 years. And treasury bonds, which are held for 10 plus years. As long as you hold the bond to its maturity date, the yield you're offered is the yield you'll lock in for the life of the bond. Most bonds have a face value of $1,000 to start. From there, markets cause the price of individual bonds to fluctuate up and down. When you purchase a bond for more than $1,000, you're buying it at a premium. That usually happens when the stated interest rate for the bond is higher than the market's current interest rate. When you purchase a bond lower than $1,000, you're buying it at a discount. This doesn't take into consideration the fact that, like stocks, bonds can be purchased by the basket through ETFs and index funds, like Vanguard's Total Bond Market Index Fund. When you're starting out, an index fund could be the safest way to go. Diversification is a key to a well-managed portfolio. The federal government issues bonds to help fund federal activities and to help raise money for various projects, like infrastructure. A government agency may issue bonds to help meet short-term financing needs. A local government, also referred to as a municipality, may issue bonds to help pay for special projects like stadiums, parks, better roads, things like that. A business can issue bonds to help raise money to expand the business, like building a new distribution center to help get their products out into the market more efficiently. The main reason is to help offset the risks that come with investing in stocks. Stocks are seen as pretty darn risky, and as of last year, 2022, we firmly entered a bear market. You can always offset risk through diversification, and having bonds as a smaller percentage of your overall investments can help lower risk. See, investing in bonds is seen as safer because they provide a steady stream of income, experience less volatility, and as far as treasuries are concerned, they're backed by the full faith and credit of the United States. As with any investments, it's really a balancing act that an investment advisor can help with. Something important to understand about bonds: in our current economy, we're experiencing something called inflation, which is the general upward trend of prices for just about everything: groceries, gas, utilities, and a wide range of services. The Federal Reserve, which you may or may not have heard of, is basically our country's bank. They help fight inflation by raising something called the federal funds rate. The federal funds rate affects a lot of things like interest rates for credit cards, mortgage rates, and unsurprisingly, bonds. As the Federal Reserve raises interest rates, the value of bonds go down. Market interest rates play a very important role in the valuation of bonds and their yields. Take this into consideration if you're thinking of selling your bond before the maturity date. Yes, you can sell that bond before the maturity date, but if the price of the bond is less than what you initially paid for it, you could lose a little on the principal. Likewise, if interest rates have gone down, you could make more off the principal. 2022 was the worst year on record for bonds because of how aggressively the Federal Reserve was raising interest rates to battle inflation. But the yields on newly offered bonds are going up, and bonds are selling at a discount. Speaking of inflation, iSavings bonds are also a way to help preserve some of your money's purchasing power. They have interest rates that are adjusted for inflation, and right now you can get them at a whopping 6.89% interest rate. Keep in mind, those are bonds you must hold for at least a year, and the interest rate changes every May and November. I talk about them a little more in my budgeting and saving video, so if you haven't seen that, go check that out here. Thanks for sticking with me, and until next time, peace out.